Hello and welcome back to our 8-part video series on types of businesses, where we explain how various startup structures like companies, partnerships, and proprietorships differ in terms of legality, taxation, capital requirements, nature of liability, ownership structure, and more. Continuing on this discussion, here's our final video on business closures and winding up procedures, helping you determine which structure is the easiest to shut down in case things do not work out.
So, let's begin without further ado. Every business journey, regardless of whether it ends due to the fulfillment of a specific purpose or financial challenges, needs to have an easy and cost-effective closure procedure. Whether it's a company, a partnership, or single-owner entities like one-person company and sole proprietorship, understanding the legal procedures and financial implications of closing a business is a strategic decision to be made before starting it. Further, in this video, we will analyze each of these aspects in detail, so that you can make an informed choice while opting a structural option for your startup.
Winding up a sole proprietorship. Winding up a sole proprietorship essentially involves shutting down the business entirely, as there's no legal distinctions between the owner and the business itself. This may happen on the voluntary decision of the proprietor or his permanent departure due to death or disability. The proprietor has to settle all the debts and liabilities personally. The process typically involves notifying the creditors, selling off assets, settling debts, and finally, deregistering the business with the government authorities and tax professionals. If the business has a bank account, it must be closed off before proceeding. Note that all outstanding debts and legal issues must be settled beforehand to avoid any personal financial repercussions after the winding up procedure ends. Wondering what are the costs involved? Well, winding up a sole proprietorship can be relatively inexpensive compared to other business structures. However, the overall cost may vary depending on factors such as legal fees, outstanding debts, and asset liquidation expenses. Coming to the timeline, a sole proprietorship can be shut down in a very short span, usually within a day or two, if the financial complexities are minimal. It all depends on how quickly all debts are settled and assets are liquidated. If things are more complicated, it could take anywhere from a few months to a year to wrap things up. Last but not least, winding up a sole proprietorship may have tax liabilities, especially if there are capital gains or losses involved in the sale of assets. All these liabilities have to be borne by the proprietor alone. It's essential to consult with a tax professional to ensure compliance with tax laws and regulations.
Winding up a partnership firm. Partnerships offer a unique blend of shared liability and flexible management, making them a popular choice among entrepreneurs and startup owners. But is winding up this business structure as easy as starting and operating it? Let's find out. Winding up a partnership firm involves dissolving the partnership agreement or deed, liquidating assets to settle debts, and distributing the remaining assets among partners. The process typically begins with notifying creditors, collecting and paying off outstanding debts, and liquidating assets by selling off inventory, equipment, and other assets to generate funds. Things might get complicated as key decisions are made by multiple partners, and disagreements or disputes may inevitably arise. Resolving these issues amicably is essential to avoid delays and additional expenses. Coming to the costs involved, winding up a partnership firm can incur various expenses, including legal fees, accounting fees, and asset liquidation costs. It's essential to budget accordingly and seek professional advice to minimize financial strain. The duration of winding up is a crucial factor as well. It may vary depending on the complexity of business affairs, the number of partners involved, the efficiency of debt settlement, and asset liquidation. On average, it could take several months to a year for the process to complete. And let's not forget about taxes. Winding up a partnership firm may have tax implications for both the business and individual partners. Individual partners are taxed on their share in the distributed assets. It's crucial to consult with a tax advisor to understand the tax consequences and ensure compliance with tax laws.
Winding up companies and LLPs. Now, let's turn our attention to the winding up procedures for companies and limited liability partnerships, LLPs. Companies and LLPs are popular choices for startups due to their distinct legal structures and liability protections. However, when it's time to wind up these entities, the process can vary depending on their activity status. Let's explore the possible scenarios.
Closing an inactive LLP or company. Picture this. Your company or LLP has remained largely dormant, with no activity and pending legal proceedings since its inception or the past few years. In such cases, the process of closure is swift and efficient through the Registrar of Companies, ROC. Let's break it down for you. The closure process, known as striking off, involves filing Form STK-2 for companies and Form 24 for LLPs with the ROC, declaring the entity as defunct. Additionally, publishing a public notice and obtaining consent from all creditors and partners are necessary steps. Once filed, the ROC publishes the name of the entity on the MCA portal, inviting objections. If no objections are received within the specified period, typically 3 to 6 months, the ROC strikes off the entity's name from the register, marking its official closure. It's a streamlined and cost-effective solution for inactive entities.
Closing an active LLP or company. Now, let's shift gears to active companies and LLPs with ongoing operations, assets, and liabilities. For companies and LLPs in business, the closure process is more complex and overseen by the National Company Law Tribunal, NCLT. Let's navigate through it. Active companies and LLPs seeking voluntary closure must pass a special resolution to this effect. The next step is approaching the National Company Law Tribunal or NCLT and getting an official liquidator appointed to settle all liabilities, oversee asset realization, and surplus funds distribution. The process itself can be lengthier and more intricate, spanning 12 to 24 months or longer, depending on the entity's size and complexity. Despite the challenges, navigating closure through NCLT ensures proper settlement of debts and distribution of assets, providing a legal and orderly exit strategy. Hopefully, you now have a clear understanding of how different startup structures can close their business operations if needed. Using this information, you can now make the right choice and assess the accurate risks of starting a business in India. Still having questions? Contact our advisors directly. Details are given in the description box. Found this video helpful? Like, share, and subscribe to our channel for more informative content ahead. Thanks for watching.